Dumelang. Apologies, guys, for taking so long to record. It's been hectic. I wasn't really well, unfortunately, for a while. It's been a while now. And I only have time to record over the weekend because during the week it's work. Let me just finish off. I was supposed to have recorded this um last week already, and because of health reasons, I couldn't, and I'm just gonna continue with it. Basically, I am continuing with this paper over here. I did say that if the video reaches 1,000 views, I will record question 2. I know it reached 1,000 views a while back, just that I haven't been well, as I've just said. Question 2 is about retained income note, the cash flow statements, and financial indicators. We are given information that relates to Swallows Limited for the financial year ended 28th February 2023. The first question, which is 2.1, requires us to prepare retained income note for the year ended 28th February 2023. Right now, all I'm thinking about is the note itself, the structure of the note. What is the first item that goes into the retained income note? Do you know? What is the first item that goes to retained income note? Let's see if you know. All right. So we've got retained income note, right? Here it is. Tell me then, what goes into retained income? Just know the structure. Tell me about the structure. What goes to retained income? The first one will be balance. I'm just gonna abbreviate everything. You're gonna have balance at beginning of year, right? And then you're gonna have da amount. Then you're gonna have profit. A lot of people make a mistake when it comes to this, but they don't understand it must be profit after tax. Okay? And then you're gonna have it If it's a loss, you will put it in brackets. They'll hardly give you a loss. Then you will have a loss due to buyback. Okay? This one I'm just gonna write a little note. It works when it will have a loss. You will have a loss if your average price per share, I'll call it, I normally refer to it as EPS, average price per share is less than your buyback price. Okay, it's BBP. And then you multiply it by the number of shares that were bought back. Otherwise, it will be a profit. If that's not the case, a profit, you will show it without brackets, which they hardly give it to you. And then we're going to have your dividends on ordinary shares. Okay, we're going to have dividends on ordinary shares. And dividends on ordinary shares is made up of two things. It is made up of your interim dividends. Now, your interim dividends are declared and paid, right? And you're going to have your final or recommended dividends. And these ones are just declared, they're not paid. They'll only be paid the following year. And then obviously, if you have your dividends on ordinary shares, you're going to add these two, put them in a box, and write them there in the line, in the dividends on ordinary shares line, and put them in brackets, right? After your final dividends, then you can have your balance at, okay, okay, there it is, at end of year. This is how your retained income note will look like. This is basically all they were asking. Okay. This information, we need to find it somehow. Um, while on that question, let me see what the answer book has. So this is what the answer book has. I've done everything. You know the structure now. What comes after net profit after tax? It is a loss or profit due to buyback, right? And for me to find information about that, I'm just gonna look at the information booklet. This part here can't really help me much. It gives me ordinary share capital. Let me just continue to the next page. This is where I can find the loss, the share capital part. They gave me number of shares at the beginning of the year because March 2022 is the beginning of the year. Let me just confirm if that is true. Yes, 2022 is the beginning of the year. So that 1,250,000 shares go with this share capital amount here. All of this is at the beginning of the year, right? So your share capital will be 12,312,500, and the number of shares will be 1,250,000. Good. Is there any issue of shares before the buyback? That's what we need to figure out. And what do they say? 180,000 shares repurchased. There was nothing before the buyback. I'm just going to stop right there. Um, but I'll just read this part here. These shares that were repurchased on the 1st of May 2022, and they say they do not qualify for dividends. Good. An EFT of 1,989,000 was issued for the repurchased. Okay. That is also very important. Um, While I say that is important, why did I not highlight this? That they do not qualify for dividends. So they do not qualify for dividends, and I will leave it there. So they don't qualify for interim dividends. When I look at it, they won't qualify for interim dividends that were declared and paid on the 31st of August. They also do not qualify for final dividends. And they didn't give us any final dividends this side. But you need to remember from what and I thought about it, I don't know why I didn't put it there. Final dividends for this year, you will find them in trade and other payables as shareholders for dividends. Final dividends, the ones that are written as final dividends in your retained income for this year, you will find it in trade and other payables this year in as shareholders for dividends. Got that? Good. I normally prepare a table or a timeline so that you see what is going on. Here's the timeline here. that I prepared. Okay. We have the beginning of the year, which is the 1st of March 2022. There were 1,250,000 shares, right? But immediately on the 1st of May 2022, what happened? There were shares that were bought back. So basically, when I calculate my APPS, I will focus on any share capital and number of shares issued before the 1st of May. And the only shares issued before the 1st of May were these ones. There were no other shares that were issued. So I'm going to use that to calculate my APPS, all right, which is average price per share. By taking the share capital that goes with that 1,250,000, the share capital that goes with that 1,250,000, it is the 12,312,500. Okay. And that's what I will do. I will divide that by 1,250,000 to get what I call EPS. EPS stands for average price per share. And I need you to understand, please watch my videos on shares and the buyback of shares. It's right there. They included in the playlist. You can check them out anytime. I emphasize that average price per share, we use it to estimate the original amount of money we received for when we issued shares. Remember when we issue shares, um, should I show you this? Let me just show it to you. Let me quickly find that document for you so that it's in one of the videos, by the way. It's in one of the videos. You can check it out anytime. It's in one of the videos just to make you understand what APPS is. It's basically, as I've said, it is the original amount that we received when we issued shares. And what I want to explain with this part of the video is that when we buy back shares and when we issue shares, what the relationship is between the two. Okay. So when we issue shares, I think it'll make more sense when I show it as a picture. Here it is. So this is a company, it's us, right? Remember when you prepare, when you write in that paper, you represent the company. And then we've got a shareholder, right? A shareholder is, I've explained in the video that has all of this. A shareholder is the person that bought shares from a company. So we've got 10,000 shares. So what we're going to do is to give the shareholder those 10,000 shares and we give it to them in a form of a share certificate, right? So the shareholders have a share certificate to prove that they own shares in a company. In return, what do we get? We get the money. You see, this money that they're giving us, it's done a lot of times. So from when we started the company, we keep on issuing shares, issuing shares. We give different shareholders share certificate. They get the shares, we get the money. But the problem is that these shares that we issue throughout, we issue them at different prices. Do you get that? We issue them at different prices. Like for instance, here, when I issued these shares, I issued them at 2 cents and I got 200 rand. But next year, when the company is doing well, I can issue them for 5 rand. I can issue them for 200. I can issue them for 1,000 per share. So all these shares have been issued, but they were issued at different prices. So it will be hard for me when I buy back shares to figure out how much did I actually receive for these shares. So that's what we do. We calculate APPS to estimate the original amount of money we received per share when we issued these shares. You got that? Because they were issued at different prices, you did stats, guys. Mean is the accurate, closest estimate that is close to the original value. So APPS, it is so close to the original cost or the issue price or original amount of money we received when we issued these shares. So in this example, we are saying that APPS in this question paper, we are saying that the original amount of money we received for these shares was that 9 rand something. It was 9 rand 85. So we received it, right? We received that 9 rand 85. Do you get it? Good. Now, what happens when we buy back these shares? So we are saying we received this per share, right? What happens when we buy back these shares? This is what happens when we buy back these shares. Check what happens. Remember, when we issue them, we receive money, which is proceeds. So in the cash flow statement, we'll say that it is proceeds from the issue of shares. When we buy back shares, remember they've got shares. Look at that. They've got our 10,000 shares. So what are they going to do? They're going to return those 10,000 shares. In return, what do? We give them their money back. In this case, their money back was that 200 rand that we received from them. Do you get it? But the problem is, sometimes it is us as a firm that wants to return money we've got so much retained income, we've got so much cash, we don't know what to do with it. We want to return it to the shareholders. So we will want to impress them. We want to encourage them to sell their shares. And the only way we can encourage them to sell their shares is by giving them more than what they gave us. And what we just pay to that shareholder, that's what we call the buyback price. What we received is APPS. What we are giving them back, it's buyback price. We buying these shares back at this price. Here it is the same. But according to what we've got here, it might be different. Because it's us that wants to buy back shares, we might actually buy them back at a higher price. Now, let's see how much we bought them back for. So this is what we bought them back for. This is the money that has all the 180,000 shares. We bought them back for 1,989,000. Now I'm going to find the price per share by dividing that by 180. Price per share is 11 rand 50. That's the buyback price. Since your APPS is 9 rand 85, this is what you received. 11 rand is what you pay. There's 9 rand is what we originally received. So when you compare the two, you will realize that what we originally received is less than what we paid for these shares. So we as the business are making a loss. You got that? We are making a loss. This result in a loss due to buyback of 1 rand 20. How did I get that 1 rand 20? All I did to get that 1 rand 20 is to take that 11 rand, 05 and you minus that 9 rand, 85, it gives you that value. How much is that value? It'll be 1,2. You got that? That's a loss. Do you understand why it is a loss? Never make a mistake of getting it wrong. So this loss of 120, they have funny ways of putting it. Normally they'll say that these shares were issued at 120 above the average price. Immediately when they say it was above the average price, so they're giving you the excess amount. That excess amount that is above the average price, it is the loss per share. Sometimes they'll give it to you as a value. Just know that it is a loss. Look at the notes that I did on shares because I gave you different scenarios of how they can ask this question. Once I've done that, what I'm going to do is to go to my retained income because that's where this belongs, right? When I get to my retained income, I'm going to say loss due to buying back, and I will take 180,000 shares and just multiply them by that 1 rand. It was 1 rand what? It was 1 rand 20. But before that, I just want to enter simple things that you were supposed to have entered already. The first thing that I will enter is this one here, which is final dividends. Because it is in trade and other payables, it's shareholders for dividends for this year. It represents final dividends, so I can just put it there without even calculating it. And now a loss will be, as I've said, the loss here will be the R1.20 multiplied by the number of shares that were bought back. And the shares that were bought back were 180,000 shares. And they were bought back at 180,000 shares. They were bought back at 11 Rand, 05. And initially we received 9 Rand, 85 for those shares, resulting in us making a loss of R1.20 per share. I'm going to take that and multiply it by 180. So that's my loss, and I will put it with brackets. Okay, you'll put it with brackets. Did you hear me? You put it with brackets. Somehow when you put that, it's like it's an insult to accounting students. They do their own thing. You put it with brackets, people, with brackets. So basically, when I write it down, I will simply say 11,05 minus 9,85 multiplied by 180. It will simply give me 216,000. You put it with brackets. Now, awesome, right? Let's talk about interim dividend. What did they say about interim dividends? They were declared. I ask you to highlight it. We can basically calculate that right now. Well, I don't know. We can't calculate that as a matter of fact. I'll leave it open for that. But these interim dividends were declared on the 31st of August. This is before shares were issued. Interesting. So how do we calculate these interim dividends? We're going to do it in the form of a table, and that's how I'm going to do it. I know that from the 1st of May, I will have 1,250,000 shares minus 180,000 shares. So I will have 1,070,000 shares left. And immediately after that, this is what I have at the end of the year, right? I have 1,370,000 shares that will be in issue at the end of the year. If you're wondering where I got that from, I got it from here. So at the end of the year, we have those shares issued. So these ones will be in bracket, right? So it'll be easy for us to calculate this question mark over there. Can easily calculate that question mark. But I did it as in a timeline. So that question mark, when I calculate it, it will give me 300,000, which is not affecting my interim dividends that were declared on the 31st of August. So I'm just going to take those shares that were issued by the 31st of August, which is 1,070,000, and multiply it by 0.32. And that will give me my interim dividends. How much will that be? 1,070,000 multiplied by 0.32. It gives me 342,400. Those will be my interim dividends. I already have my final dividends, so I am kind of sorted out when it comes to my final dividends. And that is it, guys. Once you have your interim dividends, you just add your interim plus final to get your ordinary share dividends. You put them in brackets. And then you will take 237,400 plus 1,526,000 minus 216,000 minus 917,800. You will get 629,600. That will be your retained income for this year. 9 months, just like that, in the bank, right? With a bank. Um, let us go to the next question and figure out what it is asking for. Um, Basically, this is what we have. They want us to calculate change in loan proceeds from shares issued. Okay, that is not a problem. So those are the figures that needs to be calculated as per the cash flow statement. But let me see what we have. Um, let's see what we have. Let's see what we have. Basically, this is what they want us to calculate change in loan. I'm just going to look at the loan and look at additional information and check what I've got. I see that I've got interest on loan from the statement of comprehensive income, which is 648,000, which is good. I've got a loan at the beginning of the year from Daisy Bank of 7,200,000. At the end of the year, it is 6,348,000. From there, am I given anything really? I don't think so. Basically, I'm given absolutely nothing. Um, I've got nothing. They just gave me nothing at all. Nothing at all. Nothing at all. So I'm just gonna quickly calculate it. Um, you know the structure by now. I think what they missed here is not specifying if interest was capitalized or not. But then they're making it obvious by not giving you the interest rate. But I feel like it's very, very important, even if they don't give you interest rate, it's very important to be told if interest was capitalized or not. That is very, very important. You know the rule, right? You know how you need to calculate the the change in loan. So what we have as a balance at the beginning of the year, it's 7,200,000. We had interest on loan, and when we have interest on loan, we're gonna add it to get the closing balance, which will be 6,348,000. But this is only applicable if interest is capitalized. But they didn't give us accrued expense that relates to interest on loans. So we can simply conclude that it was capitalized, but sometimes I just need to tell you. Um, Now we're missing repayments here. To calculate those repayments, you just work backwards. You will take that 6,348,000 minus 648,000 minus 7,200,000. It'll give you the repayment towards the loan, which will be 1.5 million, right? But in that 1.5 million, I need you to understand that there's interest in there. There is interest in there. And here, when they say change in loan, they're looking for the amount that will record under financing activities as repayment of the loan, which is normally your repayment minus your interest. And that will give you 852,000. Got it. We good? Awesome. Proceeds from the issue of shares. I think we have calculated this partly. Shares issued here will be 300,000. They told us for how much they were issued for. They were issued for 11 Rand 40. So you will just take 300,000 multiplied by that 11 Rand 40 to get the proceeds from the issue of shares. You got it. Good. It's showing me something else now. This is what I'm looking for. All righty. And now they want us to calculate this. But already for this, operating effects of operating activities, we are missing something there. There are three things. It is IID, which is interest paid, income tax paid, and dividends paid. And what we're missing is interest paid, which we have already, which is that 648,000. Paid means you put it in brackets. Now we want income tax paid. I also did thorough notes on these. When it comes to income tax paid, you only look at your income tax. And when you look at your income tax, I will just check where it was. Income tax, last year it was 42,100, but it's credit. When it's credit, when it's CR, it means it was in trade and other payables. So we were owing that last year. What must we do this year? Get it back. So we were owing it last year. Sorry. Please erase what I just said a second ago. We were owing it last year. So this year we need to pay it. Pay it. Because it was in trade and other payables. The fact that it's CR, it means credit balance. The credit balance goes to trade and other payables. Trade and other payables represent current liabilities. Current liabilities is what we owe. So we were owing it last year. So this year we need to pay it. It was a current liability. It must be paid within 12 months. We are at the end of the 12 months. So we need to have paid it during the year. So we're going to show that with brackets. We're going to show that with brackets. Balance the beginning of the year, you show it with brackets because we need to pay it. And then we're going to look for income tax for this year. Oh, it's not given. Instead, they gave us your net profit after tax. Please understand, they gave you the tax rate as 30%. It means that 1,526,000, it is the 70%. How did I get that 70%? Check out my videos on dividends. I explained that thoroughly as well. It has to do with provisional tax payments. It's up there. So what they did here is that your profit before tax is 100%. When you minus tax, you will get 70. So that means this 1,526,000 is the 70%. It is the 70%. Now the tax is 70. The tax is 30. So if we want the tax, I'm going to take that 1,526,000 and multiply it by 30 and divide it by 70 to get my income tax and just put it in brackets. Got it? Let's look at the end of the year. Where is our sales income tax at the end of the year? Sales income tax at the end of the year is debit. Debit means it is in trade and other receivables. If it's sitting in trade and other receivables, it means we overpaid our tax for this year to the extent that SARS ends up owing us. So we overpaid for this year. So it's an outflow. If you don't look at it that way, look at it this way. Because it's in trade and other receivables for this year, we won't receive it this year. We'll only receive it next year because it's still owed to us. That's why it's in trade and other receivables. So it will only be an inflow next year. So for this year, it's an outflow. You got that. Depends on how you want to look at it. All right. So I'm going to show it with brackets. brackets. And then to get my tax paid, you just have to add everything up there. So it's minus 43,100 minus 654,000 minus 23,600. It'll give me my income tax paid of 719,700 on 100, right? I know. Easy, right? Dividends paid. With dividends paid, oh, that is awesome, though. I will use a method that I prefer. I realize that I have interim, I mean, I have final dividends for last year, and I've just calculated my interim dividends. So dividends paid is last year's final plus this year's interim. Or you can use that long table, which is similar to your interest paid. Yeah. But here, basically, you have two options here. So what you were owing in terms of final dividends for last year, which is 475,000, you'll put it in brackets. So I'll give you that alternative, but I didn't use that alternative in here. I just said my dividends paid is just your interim for this year plus last year's final, and it gave me my dividends paid. And then you can use to calculate your operating activities. So it was that 2,340,300 minus 648,000 minus 719,700 minus 817,000. But what is the other way for calculating that interest paid? Here's the other way. You take your, I mean, not your interest, dividends paid. You take your final for last year, and then it'll be 475,000. And then you take your ordinary your dividends on ordinary shares for this year, which we got from retained income, and that will be 917,800. So you will put that in brackets, which is a minus when you put it in brackets. 917,800, and then you add your final dividends for this year, which is that 575,400. That one, we're still owing it. It means we will pay it next year. So that's why we're adding it back. Okay, why didn't I just do this at the beginning? So I was going to say 575, 400. It gives me my dividends paid, which is the same as what I got there. So it's up to you as to how you want to calculate it. But in the exam, I just want to save time. I don't have time to waste. All right. And that's it. I don't think that is worth 3 marks. It's probably worth more. Um, Let me quickly check. It is worth 9 marks. No, it can't be that. It is worth 10 marks. What's the next question? They want us to calculate what? Current ratio. Interesting. I'm going to start with the formula. These ones are nice, guys, because you just use the formula to get these. Excuse me. Current ratio is just your current asset, is your current liabilities. And from what we have there, let me check what we have. With respect to current assets is this much, current liabilities will be that much. You compare the two, you know how to simplify the ratio, right? But here we need to make sure that the second part of the ratio. So we normally, current asset will be the first part, current liabilities will be the second part. But we want the second part to be 1. So we're going to divide both sides by the second part, which is at 822,000. When you take 1,479,600 divided by 822,000, you will get 1,8 is to 1, 2 marks. Apologies. That's what we have. Guys, as I've said, this is all about the formula. So when you calculate your net asset value, it's then value, the actual value of the company as a matter of fact. But this is not according to the market, it's according to the book value of the assets and liabilities of a company. Even though we're going to compare it to the market price, but this is what the value, when they say the net worth of the company, this is the net worth of the company per share. So you're going to take your shareholders' equity, which is, remember what is shareholders' equity, guys? Shareholders' equity, it's your ordinary share capital plus your retained income. And then you divide this by the number of shares issued, which we do have. It was that 1,370,000. Do you remember it? Yeah. Now we just need shareholders' equity. Let me see what we have for shareholders' equity. It is just your ordinary share capital plus your retained income. But we were not given the retained income, so we're going to use the retained income that we have. Where is it? It is right here, which is the 629,600. Okay. So your numerator will be the sum of ordinary share capital plus your retained income. Nice, right? Easy. Hmm? Yeah. It's quite easy, guys. It's quite easy. So this is what I'm gonna have basically. That is must be uh yeah, that's what I'm gonna have. And then you just times this by 100, you will get 1 rand 1,064,90. Hmm, that's a good net asset value actually. It has a good net asset value. That is what we call the value of the company per share. Got it? Let us move to the next part. We need to calculate the percentage return on total capital employed. Um, and then they gave us the average capital employed, which is 20,343,500, which is good that they gave it to you. And because this ratio has two formulas. Initially, I used the end of the year until I noticed that they gave us average capital employed, which is at 20,343,500. So they need to be specific as to which one they're asking, because the other one is return on average capital employed, and the other one is just ROS, which is return on capital employed. But I guess that total means average, and that's how they were looking at it. But I think they were just supposed to have been specific as to which one they're looking for. Um, so the formula here is always profit before interest and tax, okay, before your financing costs in essence and your tax obligations. So that profit is what you're going to have. And you need to remember what is capital employed. It's what has been invested in the company. The company can seek financing in two ways, through loans, borrowing, which is non-current liabilities, or through issuing shares and using retained profits. Okay, so that one I'll look at it. That's why I said in two ways. That one I'll look at it as one, which is your issuing of shares and using your retained income. Okay, so it's actually in three ways when you look at it. That is the way the company can be financed. So that's why we're gonna say it's shareholders equity. Remember shareholders equity, guys. I calculated this and it worked out just fine to get that 20,343,000. What they did is that they took your ordinary share capital for this year and last year, they added it with retained income for this year and last year. And I got the value here. Let me just show you. The value that I got is this one. It's 40 million or something. Okay. It's 40,684,000. So that's what they used. And then they divide it by 2. Please know that we were given profit after tax. To get the profit before tax, you have a choice of taking this 1,526,000 and then you add the tax amount that we calculated, which was how much? How much was that tax amount? It was 654,000. You could have just added the 2. Or you do it the way I did it, which was what I found easy. I just multiplied by 100 because I want profit before tax. I told you earlier on, profit before tax will always be at 100, and then you divide it by 70. You add your interest expense, which is interest on loan of 648,000. Now, putting this into your calculator, it will give you a return on capital employed, which is 13.9. Remember, your return on capital employed must always be greater than your interest on loan. Otherwise, the business is not doing that well. Okay, we good. Sure. All right. In the next one, guys, we'll be looking at the interpretation of financial information. We have done some of it, but we'll get deeper into it. Thank you for watching. I still appreciate it, and I still appreciate you. Thank you, thank you. Thank you. Let your friends know about this channel. Let's keep watching and make this accounting thing easy. Enjoy your Sunday. Khotso.